My research at CIFR focuses on Australian equity funds and examines whether Australian fund managers adhere to the portfolio constraints they declare in their investment management questionnaire responses. In particular, the constraints I analyse are the number of stock holdings, portfolio concentration, and degree of trading. While the investment management questionnaire responses carry no legal weight, unlike a product disclosure statement, they entail considerable effort in their preparation and are widely distributed among asset consultants. There may also be reputational incentives for funds to adhere to their stated objectives. Given these factors, examination is warranted to determine whether or not the questionnaires do in fact contain reliable information. The use of Australian managers is pertinent to this study, given that Australia's pension market, valued at $1.6 trillion is the fastest growing in the world, ranked fourth largest internationally, and is strongly influenced by the clients of asset consultants, who are the intended users of these questionnaires. In order to examine the portfolio constraints, I use a database of 37 active Australian equity funds and investment management questionnaire responses, daily transactions, and monthly equity holdings data spanning 15 years. In matching questionnaire responses with holdings data, the study finds that 53% of fund managers comply with their self-declared number of stock holdings, with compliance improving from 30% pre-2000 to 64% post-2000. This correspondingly increases the reliability of the indicator for asset consultants who factor it into their manager selection decisions. In contrast, fund managers generally exhibit less compliance with their self-declared maximum portfolio turnover rates, with a compliance rate of 30%, while tracking error is the most systematically underestimated questionnaire response variable, with a compliance rate of only 25%. These findings apply equally during periods of market strength and weakness. Declaring a lower maximum turnover rate may lead to the expectation of lower transaction costs than what actually transpires. Similarly, underestimating tracking error improves a manager's expected information ratio, which is calculated by dividing excess returns by tracking error. It is unclear whether these mismatches in self-declared characteristics versus recorded data are due to systematic underestimation on the part of fund managers, or whether there is an element of intent at play. The study's findings are relevant to potential institutional clients of active fund managers and the funds management industry in general. Overall, our study suggests that the questionnaire responses do contain some information value when used by asset consultants to compare funds. Increased efforts to maintain the currency and accuracy of questionnaire details will correspondingly improve their information value.